A single headline can just tank a stock. But what if that headline is only like half the story? What if, behind a massive drop, there's actually a sign of incredible strength? Today, we're unpacking the really perplexing case of Worthington Steel. So, on March 26, this was the story for Worthington Steel, a stock price drop of nearly 17% in just one day. Wow. That's a brutal result for any company, and it immediately makes you ask one big question. So, what happened here? Was this just a sign of deep, deep trouble, or was something else entirely going on? To find the real answer, we've got to dig past that headline and get into the numbers. And the immediate trigger becomes clear pretty fast. Wall Street had its expectations, right? But Worthington Steel, well, they delivered something very different. They missed big on earnings per share, coming in at 27 cents instead of the 47 cents everyone was looking for. And revenue? They missed by over $113 million. I mean, that's the kind of miss that just sends investors running for the hills. But a miss that big is usually just a symptom, it's not the disease itself. To really understand the story here, we need to decode the disappointment and take a hard look at the powerful headwinds this company was sailing against. The company's own CEO, Jeff Gilmore, he painted the picture perfectly. He described the quarter as volatile and uneven. That's not just corporate speak. That phrasing is key. This wasn't some steady decline. It was a really rough, bumpy ride. Okay, so let's break down those challenges. First, their profit margins were getting squeezed. Then, on top of that, you had this 1-2 punch of the holiday season and some nasty winter weather, which literally slowed their operations down. And with all this economic uncertainty floating around, their customers were playing it safe, keeping inventories really low, which of course meant fewer orders for Worthington. And the pressure wasn't just domestic. Nope. You go across the Atlantic, and the story gets even more complicated. Their European operations were also in a really tough spot. How tough? Well, their European business, Sedam, saw its earnings drop by $8.4 million. And the cause was a story we're hearing a lot globally. Weak demand and just incredibly intense competition, especially coming from China. Now, to really understand this impact, you have to know who their customers are. Automotive is the giant slice of the pie, right? 55%. But look at the other significant pieces: construction, machinery, heavy trucks. This context is absolutely crucial because it turns out these were the exact sectors that were hurting, because those were the very sectors showing real softness. Shipments to heavy truck manufacturers were down 12%, construction down 7%, and energy and service centers, they saw even bigger drops. So the crucial point here is that the weakness was spread across several of their key end markets. But remember, this is a complex story, and if we only focus on the negative, we totally miss the whole picture. Because hidden just beneath those tough headlines, there were some serious bright spots. And the biggest bright spot? It came from their biggest market. The CEO made it clear, despite all the headwinds, the team was executing, and that was especially true in the automotive sector. And get this, while overall production for the big Detroit automakers grew by a pretty modest 3%, Worthington Steel shipments to them grew by a massive 13%. That doesn't just happen by accident. That is a clear sign that they are winning new business and actively taking market share from their competitors. And here's another hidden piece of the puzzle. Because profit is one thing, but as any business owner knows, cash flow is everything. And even with lower profits, the company was a cash-generating machine, and that's a vital sign of a healthy operation. The numbers absolutely back this up. They generated about $63 million in cash from operations, and around $33 million of that was free cash flow. That's the actual cash left over after paying for everything you need to maintain the business. It's money they can use to invest, pay dividends, and just strengthen the whole company, all while weathering a really tough quarter. This kind of resilience allowed them to do more than just survive the quarter. It allowed them to make a huge bet on the future, shifting our focus from those short-term results to their long-term vision. And that bet is massive. They announced plans for the largest acquisition in the company's entire history, a deal to buy their German competitor, Kloeckner. This is a move that's designed to create a much larger, more diversified global platform. A key part of this whole future vision revolves around this material, electrical steel. It's a high-tech product, okay? This is not your everyday steel. Its special magnetic properties make it absolutely essential for the hearts of electric motors and the transformers that power our grid. Now, what's really interesting about their strategy is the nuance. They're seeing the market pivot. Instead of going all in on pure battery electric vehicles, or BEVs, they see consumer demand shifting, and shifting strongly towards hybrids. And for Worthington, this hybrid boom is a total win-win. They have the opportunity to supply the high-tech electrical steel for the vehicle's electric motor, and they can supply the specialty cold-rolled steel used in the traditional internal combustion engine. So they win no matter which part of the powertrain is doing the work. So how does a company navigate all these short-term storms while making these huge long-term bets? Well, it all comes down to their core philosophy, what they call the Worthington Way. And this isn't some new company, all right? They've been around since 1955, building a real legacy of innovation. A huge milestone was back in 1996 when they basically wrote down their operational philosophy into the Worthington Business System, a playbook for continuous improvement that they still use to this day. And it's not just a theory on a PowerPoint slide. This is transformation in action. At one facility, they used this very system to completely change how they handle materials. The results? A 60% reduction in work in process inventory, and now they're adding predictive AI to get even smarter, to spot problems before they even happen. Which brings us right back to where we started. A sharp stock drop that was really masking a story of resilience, of market share gains, and a bold vision for the future. And it leaves us with a critical question. In a world this volatile, is having a great long-term plan and executing it with discipline, is that enough to win?